Hello everybody, what's going on? I just got words from Kang Kai, Nio's Vice President of Marketing, and the number he's dropping are absolutely massive. The all-new ES8, their flagship luxury SUV, is not just in demand. Their production is hitting historic new speed. The delivery target for the all-new ES8 in November is expected to reach an incredible 10,000 units. Kankai confirms this represents the fastest production capacity ramp-up in Neo's history. This is a clear signal that the company is effectively overcoming previous supply chain constraints and scaling manufacturing with impressive efficiency. And the acceleration isn't stopping there. The production capacity in December is optimistically projected to reach 20,000 units. So, why these numbers matter for investors? Well, this isn't just about selling more cars. This is the key to unlocking true value of Neo stock. First thing is that volume is the path to profitability. For an EV maker, reaching high volume production is essential for economic of scale and finally turning a profit. With the ES8 leading the charge at record-breaking speed, this brings Neo one huge step closer to their goal of achieving sustained positive margin. Second, this proves the strength of their core premium brand. The ES8 is a high margin vehicle. Strong demand and record-breaking production for their most luxurious model means robust revenue growth and a strong foundation for their overall business, which includes New Onvo and the Firefly brands as well. Neo is no longer just a story of innovative technology and battery swapping. It is now a story of execution and scale. We have seen the demand. The question was always, can they build them fast enough? The answer, according to the latest data, is resounding yes. We have got the new ES8 ramping up. We have the successful launch of the Onvo sub-brand for the mass market. And we have the global expansion underway with the Firefly brand. These production milestones are the financial proof that the operational gear are finally turning at full speed. However, the question here is that what does all mean for the new stock? It means the operational risk that have long waited on the stock price are receding, and the promise of massive future growth is moving into reality. So keep a close eye on those delivery numbers because they are the fuel for this stock. For long-term investors, this aggressive successful production push is a clear signal to be bullish on Neo's future.
Hello everybody. So Neo stock is gearing up for next major earning report and right now Wall Street is starting to beat the drum loudly. There was a massive call out from a top investor ahead of this release, basically saying the turnaround is here. Today we are breaking down why the sentiment on Neo is changing from panic to potential and why this EV giant is about to shift into its highest gear. Let's look at the numbers. The first and most immediate catalyst for Neo bull case is simple: the moving metals. We have seen a record-setting delivery numbers in recent months. We are talking about massive year-over-year growth in some recent months, soaring over 90%. This isn't just incremental improvement. This is a clear sign that new models are resonating with the premium Chinese customers. And this is where the story gets really compelling and frankly overlooked. For longest time, Neo's margins were thin. That is changing rapidly, driven by two key initiatives: scale and self-reliance. First, as they hit these record delivery volumes, those economic of scale kick in. We are seeing gross margin move back up, with analysts projecting a clear path to high teens, potentially 18 to 20 in coming quarters. This is crucial financial inflection point. Second, their innovation is translating directly into cost saving. Neo is developing its own advanced tech, including its self-developed advanced driving assisted system. Swapping out expensive third-party component for in-house tech is estimated to save a significant amount of money off the bills of material per vehicle. That's not a one-time win, that's structural recurring margin improvement. And let's not forget the strategic scale play, the launch of Onvo and the Firefly brands. This isn't just about selling high-end cars anymore. This is about dominating the mass market segment in China and globally, multiplying their volume and achieving true scale to compete with likes of Tesla and BYD. The market often overlooked Neo strategic moat, the BAS, and its industry-leading battery swapping network. This service drastically reduced the initial purchase price for customers and provide unmatched convenience, making Neo's vehicles sticky and appealing in competitive landscape. And it's not just us saying this. Wall Street is finally catching up. Top brokers like Citi have been bullish, even putting the stock on their upside catalyst watch, arguing that the current valuation fails to factor in massive sequential rebound in shipments and margin recovery we just discussed. They see the production ramp up, the new models, and the cost structure improvement creating a powerful rally. Yes, the Neo has been volatile. Yes, the Chinese EV market is tough, but the numbers don't lie. Delivery execution is strong. Margin recovery is underway thanks to cost saving tech and new multi brand strategy, which is set to explode their market reach. The execution risk is shifting to execution reward. Neo is transforming from a promising startup into a profitable powerhouse. If this earning report confirms the trajectory we are seeing in the delivery numbers and margin outlook, Neo stock won't just move, it will run. So get ready for it. Hello everybody, I'm back and so are the institutional investors. You can see the clear uptrend in the final month of the bar chart from the latest filling. This isn't retail investors. We are talking about massive hedge funds, mutual funds and major financial institutions like UBS AG Group, Morgan Stanley, Jane Street, and others are increasing their stake in Neo. When the big money moves, it signals a strong conviction. So, why are these sophisticated investors suddenly feeling the electric charge from Neo? Let's break down the three main catalysts that turning this high growth EV player into prime investment. The first and perhaps most compelling reason is the massive jump in deliveries. Neo is no longer just a premium EV brand. They have introduced a multi brand strategy with new, more affordable lines like Onvo and the Firefly brand. These core Neo brand is setting monthly delivery records with massive year-over-year increase. This volume surge essential for achieving economics of scale. Also, don't forget the Onvo effect. The Onvo L90, an affordable SUV, is already outselling the core Neo brand in some months. This expansion into the mass market segment is how you capture significant market share and diversify risk. Institutional investors are betting that this aggressive volume growth, driven by tiered product strategy, is the fastest path to profitability. They are seeing the foundational sales momentum that can turn a high growth company into a sustainable one. Second reason is the tech and infrastructure advantage. Neo strategy goes far beyond just selling cars. They are building a genius ecosystem, and that's an enormous moat. Neo's unique BAS completely remove range anxiety and offer a fast, more convenient solution than traditional charging. That proprietary infrastructure creates a stickiness for their customer base that is hard for competitors to replicate. Apart from that, the recent move to license their in-house autonomous driving chip, the Senzi NX9031, to an external company signals a new path to diversify revenue and monetize their years of massive R&D spending. This showcases the technical prowess as more than just a car company. The institutions are investing in a technology company that also makes cars. They see a company that control its power infrastructure, and is even creating new revenue stream from its internal technology. Third important thing why institutional investors are investing is the path to profitability and valuation upside. Let's face it, for a long time the risk with Neo was the consistent net loss. But the narrative is changing. They are targeting profitability. Neo has been very transparent about their aggressive cost cutting and their clear target to reach their first profitable quarter soon. The massive increase in high margin vehicle delivery combined with cost optimization is making this goal look achievable. When sophisticated investors see a stock with high growth potential and a clear, albeit challenging path to profitability, they often look at the discounted valuation. With the stock trading at a relatively low price to sales multiple compared to some peers, institutions believe the market is undervaluing new future earning potential. The increasing institutional ownership suggests the market is starting to price in the successful execution of growth and profitability plans. So the bottom line is clear here. Institutional investors are not just chasing a trend. They are making a calculated bet on a company that has successfully pivoted to a multi-brand high volume strategy, all while maintaining a technological edge with its unique powered swap ecosystem. The massive financial backing from these major institutions provide a powerful vote of confidence, signaling that they see Neo as a winner in the global EV race. The risk is still there, but the reward potential is substantial as the company shift from a growth at all cost phase to one focused on profitable and massive scale.